Welcome to investments. You have gone into the Facebook page to look at previous exam reviews. I'm setting it up just the same. So if you had started, you're not at a disadvantage for that. Same content, same setup. It won't be the exact same questions that I asked last year, but pretty close. Alright, so you can expect 10 true false, 12 short answer, 4 calculations, and 5 multiple choice. One of those calculations you already know will be that setup of here's a bond and here's a government bond. So with that corporate bond, you'll need to calculate yield to maturity and yield to call. And I'll give you the assumption of when it would be called and how much that call penalty would be. And then calculate the taxable equivalent yield for the government bond. And I'll tell you if it's taxed at a state or federal or neither, but you know what that is, you know what those rates are. Your barons, same idea as before. You come prepared with an article you're choosing and tell me about it. What did you learn from it? How can you apply it? And give me a title. Let me have enough information that I'm able to pull that exam up or pull that article up. Alright, so same questions you keep seeing. Allie, why do we invest?
To increase wealth.
Yep, we're just trying to make money, and everybody else in the market is trying to do the same thing. So we are competing for the dollars out there. What is the relationship between risk and return? Positive relationship? Okay, so if I increase the risk, I expect greater return. So it's not that I'm guaranteed return, but why take on additional risk unless I expect that additional return? For our clients, we want to know what their risk tolerance and risk capacity are. So risk tolerance, the psychological, I'm going to freak out if I lose this money, versus the capacity that is, I am going to be living in the streets and eating cat food if I lose this money. So those could be aligned well or not. If you have a household, maybe husband and wife, one is more risk-seeking and the other is more conservative, we're trying to find a balance for that household. Wherever they are in that, we want to diversify their portfolio. So that's the big takeaway for this class, is the ability to create a diversified portfolio. Graduate students, you're doing that for your project. Undergraduates, you should have the ability to create a diversified portfolio, whatever the risk tolerance, risk capacity of your client is. Alright, so we have this idea of bulls and bears, where the bulls are charging forward, they think the market's doing well, it's going to go up. The bears are hibernating, so they are either just not selling anything or they are not buying anything, but they're not really participating in the market. They think it's going to go down. They might sell now if they think it's going to go down in the future. They may just be uncertain and not taking action. With our markets, long would be, we think it's going up, we're a bear. We're a bull. Short is we're a bear, we think it's going down. The different ways we can buy stock is we can create a market order. I'm willing to pay whatever the market price is at this exact second. Or I can put those different limits in, where I say, okay, it's selling for $100.28 right now. I'm not willing to pay more than $98. And I can set that to be good forever, good till the end of the day, good till I manually go in and cancel it. A lot of options. And same idea for selling. I can say, I want to sell this asset that I own, but only for a specific price. If I can't get my asking price, I'm not willing to sell it. And I can put something in where I say, sell it when it reaches this price. I don't want it to go any lower. So I could do that ahead of time so that I'm trying to stop some loss. With a margin account, what am I doing, Alexis?
It's on margin, so
we're taking on additional risk, and 50 and 25% are magic numbers there. 50% is the bare minimum I have to have in that account, and that's set by the SEC, not Fidelity or Vanguard or whoever you're doing this through. And then 25%, if the investment drops, they're going to say, hey, you need to put more money in the account. So, like Abby said, this is magnifying my potential for gain or loss, depending on where it goes. I can use those other dollars to invest somewhere else, or maybe I just don't have those dollars. Costs, it's pretty cheap to get into the market if I'm going to do it all myself, make the decisions, buy and sell. If I get advice, so I go through a brokerage firm and there's somebody who is there working to research what investments might fit for me, they're going to charge money because they're putting in the work. But if I'm doing it myself, I'm not paying that. For a comprehensive financial planner, you would be potentially doing this for your clients, doing the research on the investments. You might have somebody or a group in-house that will do this specifically for investments. And they're maybe not dealing with the clients face-to-face, not presenting plans, not dealing with insurance, all those other aspects that a comprehensive wealth manager would do. Or you might be outsourcing it entirely to a third company. They're getting paid, you're getting paid, the client is paying for all of that. So to justify what you're doing for them, that idea of efficient markets, we're not consistently beating the market, but you're providing additional value. You're making sure that their portfolio is diversified. You are making sure that we have these different investment goals and time horizons matched. So when they want to buy a home, when they want to get their children in college, we have sources for that. We figured out a plan of a 529 account or maybe a Roth IRA where those things are paid for. We have helped them with their insurance to help protect them from loss of wealth should they lose their job. We've got disability. We've got short and long term in that. We've got different government programs we potentially apply to. All this expertise we're bringing to add value to their life. They don't have to worry about this. But for the most part, we're charging based on assets under management. We would be one of those parties in the market, but here we're looking more at those market makers who make their money on the spread, the difference between what they're buying and selling assets for. We have this idea of blue sky laws. We want transparency in the market. So the regulation is out there to ensure that companies are giving you accurate information. Sarbanes-Oxley required that companies in the wake of Enron would have outside auditors come and verify that their numbers accurately reflect what they're doing, so we can trust those numbers. Those numbers are filed. We've got an annual filing that we saw on Edgar. Anybody with internet can have access to it. So every publicly traded company is providing these transparent, third-party audited numbers. With this shelf registration, this idea of all the information is there. We had the Investment Advisors Act of 1933 for IPOs, and then 34 for all the existing companies out there. All their financial information has to be shared with you. If the CEO of a company sells a bunch of the stock of the company that he's working at, that's going to be recorded. So we would know almost immediately when something like that happened, and then that gives you information. Well, if he's selling, does he think it's going to go down, or is he buying an island? So figuring out what you want to do based on that information, that's all out there, that's all available and transparent. That's that blue sky idea, and we want everybody to have access. I mentioned the IPOs. That was the Investment Advisors Act of 1933 that required the shelf registration, so all their financials were good. But I gave examples of two companies who, despite having good financials, ended up not being good. Remember what one of those was, I think. Selena. So CVS and Walgreens were investors in it. Financials looked great. Do you remember, Lewis?
Wasn't it the people that had like a product, but they didn't actually have a product?
Yes, exactly. And she was the, I think, niece or granddaughter or something of somebody from Enron, so same setup there. But instead of cooking the books, she didn't have a product. She claimed to have this device that could take a pinprick, take just a little drop of blood, and diagnose all these different things. The idea was a great idea, and that's why there are all these investors, but there was no actual product. They never actually completed what they were doing. So, despite having an IPO that looked great because we had all these investors in it, there was dollars going to it, so on paper it looked great, they just didn't actually have the product. So still risks out there. And IPOs are going to be riskier than a company that's been out for a while. That has a proven track record, that already has assets, that has these different, maybe already has built up a brand. That piece of Edgar that was just on their brand, you remember what that was called, Grant? The piece of value, when we looked at their assets and liabilities, we looked at it on the 10K, yes. But what was it that the name Coca-Cola is worth? Goodwill. So goodwill is that thing that we make up. When we saw some of those calculations we did in chapter 5, I think, on the ratios, depending on how you calculate that, we may not agree with what they say goodwill is, because that's 5 million or whatever it might be. If I'm trying to compare different companies, I want to make sure that the goodwill is addressed in the same way. They could discount it entirely, or maybe I want to put in something different, but I want to know what went into the math when somebody else was creating that ratio. And speaking of math, we had a lot of calculations where we looked at, if I invest something today and it earns a certain rate of return, how much will it be worth 20 years from now, 40 years from now, 5 years from now? Maybe it's we're saving for retirement or some other purchase, but giving these assumed rates of return, what's that going to get me? Or we calculate the internal rate of return. I invested this much over this period of time, maybe I made some additional payments into it, and in the future it was worth this much, or today it was worth this much. So I can look at what was my actual rate of return. What was the issue when we were looking at maybe grandma's house that tripled in value? And we said it tripled in value, but if we took it over the time period, how would it change? The holding period. Allie, can you help her?
The shorter, the better rate of return? No.
It would be, yeah. So if she bought the house last year and sold it this year for 3 times the amount, awesome. Our internal rate of return at one period per year would be the same as a holding period return. A holding period return doesn't take into account the time that you held it. So that was the weakness of that calculation, and why we preferred the internal rate of return that you can do on your calculator. We do compute IY. With the calculator, what are some issues we might have? Why do you tend to, or why will there be missed questions? When would you get an error?
You know, put in the correct sign.
Yeah, good. Correct sign for what?
Present value or future value.
Perfect. So present value and future value have to be opposite sign. The tricky part is that payment. It has to match one of those. So you gotta conceptually think through how that's gonna go. Normally you think it's coming out of my pocket, so that's a negative. But however you view it, you'll get the right IY as long as you have PV and FV opposite and payment matching the appropriate one. If I'm pulling money out or if I'm putting it in, is gonna make a difference. What other errors might you have, Alexis?
Make sure it's in the correct mode, so either end mode or beginning mode.
Okay.
And then make sure you clear the calculator before you start your calculations. And make sure that you have the correct IY.
So you may not know
PY.
PY, yeah, so the periods per year. Now when you're gonna have to manually adjust, when I clear time value of money, it clears all 5 of those, in the time, IY, our rate, PV, present value, payment, and future value. All those would be cleared, but my periods per year that I manually set would remain until the calculator dies, or battery dies. So I'll have to manually adjust that each time, or I can check and make sure that it's in the correct periods per year for the calculation that I'm trying to do. With begin and end, let's go to that. When would it not make a difference which mode I'm in?
End mode because the calculator is already in end mode. But you
Well,
put it in beginning mode when it says annuities due, or if it's just like at the beginning.
Yeah, so I would say this is happening at the beginning of the month, beginning of the year, or annuity due, meaning that it's paying you right away. Can you help her, Abby?
Can you say the question again?
When would it not matter which mode I'm in? I'm gonna get the same answer either way for begin or end.
Well, there's no payment.
Correct. So begin mode makes the payment at the beginning of whatever our period is. If there's no payment, if this is just, I invested this amount for 20 years, but I'm not gonna add to it, what's it gonna be worth? Begin, end isn't gonna matter. The money's already there. Alright, so from our clients, we wanna know, why are they here? What is their goal? When do they wanna retire? Do they wanna fund their children's education? How old are the children? Do the parents want to fund an Ivy League education, or maybe a state school, a community college, no college at all? Whatever it is they wanna do, we're figuring out how they want us to plan for them. So why are they here? What's the scope of our engagement? If this is full comprehensive wealth management, we need all their information, balance sheet, income statement, for the financials, balance sheet being that same idea of net worth, assets minus liabilities, income statement are cash flows, what dollars are coming in, what are going out. And we can have that correct for today. This is a snapshot in time. So that net worth, that balance sheet is going to look different in 20 years. So we're gonna project some of that. We are going to maybe assume a greater income. Maybe they're expecting an inheritance. All that we can build in. And then the big thing that you do for your clients is create the diversified portfolio. In order to do so, we need to know what different assets we can invest in, what type of risk tolerance, risk capacity they have, and with those goals, how long we have to save for different things, and what dollars are coming in. So all this goes to create our investment plan, keeping in mind that we have other things that as a comprehensive wealth manager, you would be helping them with. Capital gains. What do we pay in capital gains, Ellie?
0, 15, or 20%?
Or the short-term
Nothing.
capital gain? Ordinary income. So that's gonna be the highest one. So we try not to have short-term capital gains. And if we're going to buy and sell something in less than a year, still need to know what type of account could I put it in and not have an impact on my income or on my income tax.
Did you ask the question?
Yeah, I buy something today and I sell it 3 months from now. How do I avoid paying short-term income tax? What type of account could I put it in? What were our tax advantaged accounts? You got it, Lewis?
The Roth IRA,
Yeah, so some type of tax advantaged account. For an individual, we have the IRAs, Roth or traditional. Roth meaning I put my dollars in after they've been taxed and they grow tax-free. Traditional, I am able to take a deduction now. Probably you'll get into the nuances of that in retirement planning. But when I take dollars out, I'm paying ordinary income tax. With both of them, if I take it out before I'm eligible to, or for one of the, not for something that has an exception to the rule, I'm also paying 10% penalty on that. But if I am using it correctly, I'm either tax deferred or tax-free growth. We could also have this in an employer-sponsored plan that gives me those potentially Roth or like a traditional IRA tax deferred growth. So let's say I have a taxable account, and like Ellie said, we're paying 0, 15, or 20%. For the most part, 15%, and I have gains. So I'm paying 15% of that gain. What about losses? What can I do with those, Fran?
You can, deduct your gains, or then if you have excess, you can carry forward.
Yes.
those losses.
When you say excess, how much can I have this year?
Is it 3,000?
Yep. So I can offset my gains with the losses, and I get to carry forward the amounts that I wasn't able to use this year. With those, we have the idea of long and short-term capital gains, and then the different ways where we would line that up to do as much as we could to offset income tax. Efficient markets, Nadia, what are 3 forms of the efficient market? Can you help her, Ally?
Strong, semi-strong, and weak.
Okay, and which one can you consistently beat the market in?
If you have insider information, you can beat the strong,
The semi-strong.
the semi-strong.
Strong is saying that information is already reflected in the market. And we look at developed markets as semi-strong. People with inside information could consistently beat the market. Active versus passive. We're looking at different things here with active and passive. Active, when you're in a mutual fund, we are actively choosing what things are going in and out of that mutual fund. And the mutual fund itself is going to do that, and they're going to charge you, the investor, for doing that work. With the passive, you're looking at an index fund where they're mimicking an existing index out there. So if it's the S&P 500 that they're mimicking, they may not buy all 500 companies that are in that fund. It may just be the top 100 or something, and that's going to have enough to where it's going to match it. If I've done that, what is my beta if I'm in that index fund? Yep, 1. Because the beta of the market is 1. If I'm 100% in the index fund, or just have this mutual fund that's mimicking an index fund, that's my market. It's 1, I'm 1. And most companies will have this set up where you're not paying a fee for the index funds. You would be paying more for the actively managed. Okay, so here's the big chart, and I'll want you to draw this. You've drawn it before. This is specifically what I want to see. When we get to 12 to 15, we have taken down the unsystematic risk, which is our different types of businesses and businesses with different types of debt or different amounts of debt relative to what they've got. So 12 to 15 different assets, the businesses have to be different things. We looked at correlation, where if they were perfectly positively correlated, they were going up or down, exactly the same. Perfectly negative, they're doing the exact opposite. And then anywhere in between, they are doing some different things. If everything in your portfolio is going up at the same time, you're not diversified. If everything's going up at the same time, then they would all go down at the same time, or likely all go down at the same time. We want a mix of different things, where over a long time horizon, it's generally gonna be trending up. And you remember our sort of average for the S&P 500, what does the market do over a long period of time? What has it done?
7%.
Maybe a little higher, maybe 8, maybe 9. Over long time horizons, we generally see the stock market giving us that type of return. How we diversify is we get those different businesses. With systematic risk, Alexis, what were our elements of that?
I honestly don't remember.
Do you remember the acronym?
No, I need to review it again.
Is that primes? So like the purchasing power, reinvestment rate, interest rate.
Yeah, and that's the tricky one. It seems like it should be inflation, which is purchasing power.
Market rate? Is that it?
Market.
Market.
Yeah.
And then E would be exchange rate, and then S would be the sovereign risk.
Yeah. So this time, I will want you to draw this for me. Give me elements of both, and now you're gonna have to define what each of the pieces do. So tell me what business and financial are under that unsystematic heading, and then for all the elements of systematic, what are they? How are they gonna impact it? Arbitrage with the day trading, you're typically gonna be losing money with that because you're paying transaction fees and short-term capital gains. But what was the type of account that I could avoid paying those capital gains, Ellie?
Roth IRA.
Awesome. So that would be where you want that sandbox where they're gonna play with something risky. So if a client does wanna do something like that, or if you're taking on additional risk for clients, we want the riskiest things, because we expect the greatest return, in the account where I'm not gonna pay taxes at all on it when it comes out. And then buying and selling within it, not a taxable transaction. Because nothing's taxed until it comes out, and if it's a Roth, I'm still not paying tax. Okay, mutual funds, that bottom one, investors paying the taxes. So it's flowing that through. They're investing everything, they're voting those shares however they want. We saw with stock, each share gives you the right to vote on different things that this publicly traded company does. If you own it in a mutual fund, you don't own those individual shares. Fidelity or Vanguard or whoever has put that mutual fund together for you, whatever that company is, they are voting all those individual shares. Most of the wealth in the market is held in retirement accounts, and all those votes are coming from the Fidelity, Schwab, places like that. So closed-end and open-end, for the most part, what you're seeing now is the ETFs, the exchange-traded funds. Difference being I can trade them throughout the day, just like a stock. I can sell it at 10 a.m. and buy it at 10:15. As long as the market's open, I'm able to buy and sell with the exchange-traded fund. Closed-end, they're not creating additional shares, that's it. And you'll see, I think we looked at a couple in Vanguard where they were closed to new investors. Existing investors could stay in it, but no new investors could be brought in, because at that point, it had grown too much. Advantages of mutual funds, we had our 3 ideas of we're automatically getting some sort of diversification with that. So instead of, if I've got the index fund and the S&P 500, instead of me going and trying to recreate it myself, for $1,000, I have exposure to all these companies, or however much I want to put into this already existing mutual fund. So the diversification, the professional management, and that's going to be key, especially key with the actively managed funds that are deciding what to put in or out of the mutual fund. If they are in the energy sector, they have some expert going and looking at the different companies. They have a team that is going to do calculations and look at the SEC filings and decide whether or not to keep this company in the mutual fund or to sell it, and at what percentages. So they could be regularly rebalancing, buying and selling things, and you're paying them for all that expertise. With the passively managed, the index funds, they're just matching it. We're not really paying them anything for that usually. With the third one was record keeping, which less of an advantage now, because if you bought a stock on your own, it would show up in your account as this is when I bought it. Loads, we had front end and back end loads on mutual funds, where you're paying a little bit to get into it with the front end, and then the back end would be when you sell it. The 12B1 fees are their advertising. They're trying to get more people to buy. Where do they invest? All over. So I just mentioned the energy sector. Could be healthcare, could be oil and gas, could be, they've got like SIN funds that invest in tobacco and firearms and casinos, gambling. Or it could be something that is going to focus on international stock or small companies. So all different types of things, different sectors, different mixes of assets inside them. They might just do bonds or a mix of bonds and stocks. Could do just large cap or small cap or growth or whatever type of thing you want to get into. So with a different mix of mutual funds, you can create a diversified portfolio. We saw our target date funds that were designed to allow you or the client to choose, this is the date that I want to retire. And by date, it's just going to be the year, but you say in 2060 is when I want to retire, and then that mutual fund, starting out when you're younger, will be more aggressive, and it will rebalance to become more and more conservative as you approach and are in retirement. We saw how we could do that for ourselves, especially if we used a mix of index funds in there. So we went into either Vanguard or Fidelity and pulled up a target date fund, one that used a bunch of actively managed mutual funds within it. So it was a mutual fund that owned a bunch of different mutual funds. And the actively managed was going to cost us much more than the one that used passively managed index funds within it. We could go in and see exactly what that mix is and take 5 minutes and do that ourselves each year to save a little bit of money. And over the long term, that's going to save a lot. If you have a lot of clients and you are just matching it, well, you're saving the money. With the mutual funds, we had this idea of, on a risk-adjusted basis, are we doing well? So if we took on a ton of risk, if we went out and bought a lottery ticket and lost, well, we had a very small chance of winning. If we bought a lottery ticket and win, awesome, you got a lot of money, but on a risk-adjusted basis, you took on more risk than you needed to. We probably could have invested in the market and had a better chance, better probability of getting a return. So with these, we had Alpha, Trainer, and Sharp, and Beta was one for the market. Beta for your portfolio, I would give you. So you could calculate that, and it's going to depend on what is in your portfolio. So Alpha, looking at the calculation, if Alpha is positive, we've outperformed the market on a risk-adjusted basis. So we start out, here's the return of the portfolio over the last year, over the last 3 years, whatever it is that I'm comparing it to. And then we are subtracting all of this. And remembering order of operations, I'll take the return of the market, subtract the risk-free rate, and I would give you both the market return and the risk-free rate. Do you remember what risk-free rate is? Wherever I'm at now? Selena? What's that?
The 6-month T-bill?
Yeah, so the 6-month T-bill, and then I argue that, well, if I'm looking at this for a year, maybe I want a government bond that went over a year. But in these calculations in the textbook, risk-free rate is going to be the 6-month T-bill, and that's what I would give you. So what did the market do? Minus the risk-free rate times the beta the risk that I took on in my portfolio. So beta of the market is 1. If my beta is 1.4, am I more or less risky than the market? More. So less than 1, less risky, more than 1, more risky. We saw earlier where if I was 1, I was in an index fund, and so I was exactly the same as the market. Risk-free rate in here, so I had to get at least the risk-free rate plus, I could have got that. Here's what the market did, times the beta, the risk that I took on. If my portfolio is greater than that, outperformed the market, less underperformed. When we get into Trainer and Sharp, we need 2 calculations at least. We have to do this for our portfolio and then be in for the market. Mistakes, return of portfolio, beta portfolio, awesome. Should be return of the market and beta of the market. Same thing with the trainer. I need to make sure that I am using the correct standard deviation, the one that lines up with my portfolio, and then the one that lines up with the market. And with those, because we needed a comparison, if you just do one, even if you do it correctly, it'll be completely wrong. You have to do both and then interpret, did I outperform the market on a risk-adjusted basis? Depending on which one we use, we could get a mix of answers. So for the exact same investment, maybe Alpha I outperformed, Trainer I outperformed, and then Sharp I underperformed. So for that unethical advisor, I can pick the things that make me look good and makes the client happy and likely to invest. But recognize that you can get different answers there. Yes?
Would it be at all possible to skip ahead to the new material and review that first and come back to this, just since we do have most of the older material on the old videos?
Sure. Where do you want to start?
I think it was, we pick up like chapter 13 for this test, or maybe 12, somewhere in there.
Okay.
I don't remember exactly which chapter it was, but
Yeah.
thank you.
Okay, so bonds, we had corporate and government bonds. So I think the next chapter will go into government bonds. With bonds, we have a contract. All the information is laid out on this contract. That is called the indenture. The indenture is going to say, here is what your coupon rate will be. Meaning I'm gonna pay you this every 6 months, every year, whatever it might be. Those will be the terms of it. I'm not negotiating it. This is what the company is saying. So with the bond, I am lending here for a corporate bond, a company some money. And I'm gonna choose whether or not to lend it to them based on what I think I'm gonna get out of it. That's why we invest, Allie. So I'm trying to make money, so I'm going to consider whether or not I wanna do this. So common features of bonds, we have this coupon rate, there may be a 0 coupon bond. If it's a 0 coupon bond, Lewis, am I paying a discount or a premium for that?
0 coupon, you're paying a premium, no, a discount, sorry.
A discount, always a discount, because all they're gonna give me is face value at the end. So I have to pay less than what they're going to give me, otherwise why would I lend them money? With the different things that might be on a bond, so I'll know that coupon rate that's coming to me, I'll know how often I'm receiving it, what the amount will be, I'll know what the face value will be at the end. If there is maybe a call option on the bond, I would know that, and I would know what the penalty is. So I'm going into it knowing exactly what I'm getting into. We have a trustee that's making sure that the company follows all of those rules. With some bonds, I may have additional powers. Those would be the basics. I'm gonna know what the coupon is, and if they don't pay it, here they're in default. And the trustee is going to go after them and make sure that they do something to make me whole. Maybe they gotta go bankrupt to sell assets in the company. The bond itself is going to potentially give me the right to say you can't lend anybody else money until you pay me back, me and all the other bondholders in this specific offering. You can't pay dividends on stocks. You can't change the course of your business. Those may or may not be there, but I see that in the indenture. Sources of risk, basically, is the company gonna pay me? And if the company is in that situation where maybe they can't pay, they have the same elements of risk that we had with stock. So all those different things that apply to the other investments are applying to bonds. Those are our risks to us. With less risk here, because we have the contract. We've lent them money and they may have to sell assets to make me whole. We looked at different types of bonds. Okay, so I'll leave it there. We looked at different types of bonds where some companies were more risky than others. We had two different ratings, the S&P 500, or the S&P that would rate them, and the Moody's that would use slightly different numbers or slightly different letters and was set up to let me know if this is a company that is a junk bond, meaning it's very risky, so I'm going to require a higher coupon from the junk bond versus the investment grade bond. We saw in our quiz our fallen angels, where they were investment grade, dropped to junk. We had some that were just based on a promise to pay, where others would be, hey, this is backed by our assets, backed by our other things. So all those will combine to inform me of, is this rate worth it? Do I want to invest in this company? So those are going to affect the bonds prices. I'm willing to pay more for a company that is more likely to pay me back. So if there's less risk to me, I'm looking at, hey, if I pay a premium on this, here's the return they're going to give me, and I feel confident about the return, cool, I'll pay more for that. If I think the company is maybe less likely to be able to pay me, they have to offer me a higher coupon to compensate me for taking that additional risk. As interest rates go down, bond prices will go up. You saw the video in class where we had those two fulcrums. You remember the video? Okay. Your math for this, current yield, here's the coupon they're paying me divided by the price. It's not very helpful, especially when I'm planning to hold this bond to maturity. Maturity is when the bond is going to pay me that face value. So let's say it's $1,000. I've got a 5-year bond. I bought it at a discount for $852, and in 5 years it matures. At the end of the 5 years, they're giving me $5,000, and in the meantime, they're paying me whatever the coupon is that was listed in the indenture. Yield to call is going to be listed on the indenture if it applies to this bond. So not all bonds will have a call feature, and the company, before exercising the call feature, because they don't want to pay that call penalty, and we saw in the math, when companies exercise the call penalty, it results in a greater yield to me than if I held it until maturity. So the call penalty is added on, and they don't want to pay that. Reasons a company might want to exercise the call penalty is because rates have changed. Instead of borrowing from you at 10%, their current market is at 6%. So they would rather pay 6%. Even if they still want to have that debt, they can pay 6% instead. They're still not going to exercise the call penalty right away. First, they're going to go in the open market and buy back as much of the debt as they can of people willing to sell, and depending on what cash they have on hand. Then they might take that, issue some new debt, assuming my indenture for the 10% didn't say that, hey, you can't issue new debt. So they might issue some new debt, and with that borrowing, they pay off go back into the market and buy whatever people are willing to sell it. And only then, after they've exhausted all the people willing to sell and they still need more, it still financially makes sense, would they exercise that call feature, forcing everybody that held it in that specific 5-year class at 10%, forcing all of them to sell it back, but they're paying a call penalty. So now instead of 5 years, it's 3 years. And that's where the math changes. Time value of money calculator keys, we're gonna have a different in. Instead of 5 years, they exercise the call at 3, in changes to 3. Our future value is gonna be the $1,000 that we were promised plus the call penalty for each one of our bonds. We saw some active and passive strategies. Passive, there were index funds that here's a bunch of bonds, we'll put them in there, and we can think about where we want to put those bonds. Maybe if we're paying no state taxes or no federal taxes or both, bonds aren't what we want to put in our Roth IRA. And generally bonds, so that's going to be the government bonds. Generally bonds are looked at as less risky than stock. So we probably don't want it in the Roth. We want our riskiest things in the Roth. We want to put the bond someplace where we pay more on it. Maybe a traditional IRA that we're paying ordinary income when we get the stuff out versus the taxable where we'd be paying 15%. Active, we had the barbell strategy where think of here's the bar and then here's the weights. I had some, and here's time, short term and long term and nothing in between. Or we had the ladder where every 1, 2, 3, I thought a bunch now, and they were maturing at 1 year, in 2 years, in 3 years, in 7 years. So we could skip some steps or make it every 2 years. We had the bullseye method where I'll buy a 10-year bond today, and then a couple of years later, an 8-year bond, a 6-year bond. I'll keep moving forward until they all mature at the same time at that bullseye. And what I'm doing there is I'm thinking, I don't know where interest rates are going to go. So instead of putting all my money into 10-year bonds, I have this goal of 10 years of having some dollars for whatever the thing is. So 10-year bond today, a couple of years later I buy some more, and it's going to be, if interest rates have gone up, awesome. Now I am lending this company money at 10% instead of the 4%. 5 years go by, it's dropped, well, too bad. I should have maybe put it there, but I'm following this strategy to try to mitigate some of those fluctuations in the rates that companies might offer. Bonds and preferred stock, we had, instead of like common stock, we had, hey, you're going to pay me that dividends, and I'm going to be able to maybe have all the arrearage. You weren't able to pay me last quarter, so make me whole this time. So we could have this cumulative payment of all the ones they missed. And I'm going to have, with a bond, likely the ability to force them to sell assets to pay me. If they go bankrupt, I'm first in line. Preferred stock, I'm not going to have that same ability. Government bonds, we had a bunch of different ones we looked at, and you can get them in very small denominations. We had our 6-month T-bill as the risk-free rate that we saw earlier, and then we have larger ones where you get $100,000. We saw where we could buy them. If we want to just accept what they're selling it at, I can go straight to the Treasury. We went to the website and saw, well, I can just, here's the rate. I'm willing to lend you money at this rate. Or we could do that auction style, but we couldn't do the auction through their website. We had to go through some sort of brokerage, bank, something to, I'm willing to do this, and then they can go yes or no. Smaller denomination and larger denomination. And we had some different taxes with some of those. You don't need to know all the different types of government bonds out there. Just like you don't need to know all the different types of corporate bonds. Just have a general idea of, well, some are going to be backed by assets, others are going to be a promise to pay. We have junk and investment grade bonds, but the same sort of ideas apply to all of them. Here's the contract. I know what I'm getting into. Here's what they're promising to pay me over whatever period of time. And here's how they are going to promise to make good. So here, this bottom one, a general obligation, they are going to sell stuff if they need to. They are going to print money if they need to pay me. Versus here, a revenue project where I'm building a tollway. Maybe there's some delays in construction or whatever. They raised money to build the tollway through these loans that we, the public, made them. Now, if there's delays or nobody wants to drive on that tollway, maybe I'm not getting paid. I would still look at it as they're still probably going to pay me, but that's gonna be slightly riskier. This after-tax yield, that was the same idea. After-tax yield, taxable equivalent yield. I take whatever they say the return is. So we've calculated out, here's what the return would be on this government bond if they made these payments. I would probably just tell you it's like 5% or whatever. So you would take that 5% and you would divide it by 1 minus whatever taxes they're saving. So government bonds, municipal bonds are gonna come with some additional benefits that corporate bonds don't. Instead of being taxable, they may say, well, we won't tax it at the federal rate, or we won't tax it at the state rate. So clients with higher tax rates, or in states that have a state tax, they would benefit more from a bond that doesn't require that. So our return divided by 1 minus the taxes they would pay. That would be the taxable equivalent yield. So that calculation I was talking about earlier, where you look at yield to maturity, yield to call of a taxable bond, and compare that to our government bonds, I would say this bond is not taxable. It's not gonna have state, or it's not gonna have federal, whatever. I would give you the information that you would need to make the calculation. And then for your client, you're gonna say, okay, this government bond offers a taxable equivalent yield of 6%. If this company that would have a taxable bond calls their bond in 3 years, your yield would be this, 6.9%. If you hold it till maturity, a full 5 years, it would be, 6.5%. And there'll probably be a bigger difference between them. When they're close like that, it's easy to make the argument that the government bond is the best choice, even though it's slightly lower, because there's less risk. If there's a bigger spread, if that yield to call is gonna give you 8%, maybe I wanna take that 8% because I feel confident that they're gonna be able to pay me. I'll get that 8% and I'll get it quicker than I would have if I had had this government bond. So there's our calculation for the current yield, where here's the annual interest, the coupon that they send me, divided by the price of the bond. Not so useful, I might still have you calculate it, but better is yield to maturity. All this spelled out in the indenture. How do I know what the payment will be? What would I give you on the calculation? Sorry, what's that?
Coupon rate?
Yeah, I would give you the coupon rate, and if it's here, 10%, 10% of our face value gives me the $100. So you would have to make that calculation. I will tell you the payment is this. I'll tell you this is what the coupon rate is, and you're gonna figure out what the payment will be. So yield to maturity, here's a 3-year bond. I would tell you it's a 3-year bond, face value of $1,000, coupon rate of 10%, and you buy it for $952. If you hold it to maturity, compute IY, you would calculate that. So you're gonna set this up, show me your work, show me this is what the yield is. Compare it to a yield to call. I'll tell you the call penalty, and you'll have these 2 things that change. Future value is now face value plus the call penalty. In is gonna be something less than what yield to maturity was. So not only am I getting my money back faster, I'm getting this additional penalty. So the yield to call should always give you a greater return than yield to maturity. Good on the calculation, want to spend more time on it? Yes, no?
I think we're good.
Okay. And then here's an example of the after-tax yield. Here, a bond that's not taxable, so just completely no taxes. to give you the tax bracket that your client is in. So, in the 28% tax bracket, federal, Texas, we're still including it. Alabama, we also have our state taxes to be included. You basically take whatever I give you here, and I would probably phrase it something very similar to that. Here's the return divided by 1 minus all of the taxes that you would be paying. Our federal and our state, or just our federal, or just the state, depending on what I tell you. So I would have you do all three for a client to figure out what is best for them. Think you can do it? All good? Alright. Okay, so moving on to options. And really, at this point, you've covered most of what you would need for clients. Most clients aren't getting into options and commodities. We've got government bonds, corporate bonds, mutual funds, stocks. With all of that, you're creating a diversified portfolio for almost all of your clients. So you should be good there, and then knowing what type of accounts to put different investments in. Getting into some additional risk here. I'm the same with margin accounts. You're probably not investing on margin for them either. Options, I want you to be able to tell me what it is. And I might, just like in our quiz the other day, the quiz game where I asked you to find a specific one, a call option or a put option. So an option itself is the right to buy or sell the stock at a specified price during a specified time period. With the American setup of that, let's say I've got 3 months. Any time during those 3 months, I can sell my option. I can exercise my option. With the buy, a right to buy, I am buying a call option. With the right to sell, I am buying a put option. And there's somebody on the other side of both of those transactions. They're the person writing the option. So the right to buy or sell, whatever the stock is, at a specified price during a specified time period. In order to get that option, I'm paying the writer a premium. That premium, let's say it's a call option, that's the limit of how much I can lose. So I'm setting a floor on my potential loss. I pay this premium. If the stock goes down, well, whoever owned the stock, they're sharing in the bad fortune of the company. They're losing whatever money that might have been. I'm just not going to exercise my option. I'm out the premium that I paid, but it's going to be a small amount compared to the price of the stock. So call, option to buy, put, option to sell. In the money, I paid, and I think on our visuals here, we're gonna have $15 for the premium. I paid my $15, and now it has gone above whatever the price is, where I'm gonna be able to get more than $15 back. I'm in the money, I'm making money off of it. Out of the money, I haven't reached that point, and at the money, I'll break even. And you got a link to watch the movie there. On the other side of those call and put options, we could be the person who has the right to or must sell the asset to them. So on a call, I must sell to them if they exercise. On a put, I must buy from them at a specified price. So if I don't own the underlying stock, I'm naked. I'm collecting premiums, and if they're never able to exercise them, cool, I keep all that money. But if they do exercise them, let's say it's a call, I took their money, and I didn't own the stock. So now I have to go into the market and pay $200 per share and sell it to them at $150 per share. So I still get to keep the premium that they paid me, but I have to go make them whole. I have to fulfill my end of the contract. Now you can see the mirror image there. The writer received the $15 premium. the buyer paid the $15 premium. So rider, great, the most profit I can make is that premium. So if I don't think it's going to go down below the strike price, I'm good, I made some money. The buyer, I'm paying the premium, that's all I can lose, that $50 per share. If it goes up, I get to have potentially unlimited profit. And then reverse on the puts. So here, we think it's going down in price. Commodities, we have our story time with Cal, where he was specifically looking at soybeans, but it could be lots and lots of different types of assets. It's not publicly traded companies, it is the asset itself. The bales of soybeans, the gallons of milk, whatever it is that we're looking at. So this futures contract is me saying, I want you to deliver me 1,000 barrels of oil. And you say, cool, we will deliver it on a specified time, and I'm probably not in real life actually gonna take that oil. I'm gonna sell off the contract to somebody else. But it is me speculating that it's gonna be worth more, and them hedging. They know they have a ready market to purchase it, that I've guaranteed to do it. So the example I used in class was with soybeans. So speculators, I'm trying to make money. Hedging, I am trying to not lose money. I've got a guarantee this is what I'm gonna get. So I'm losing out on potential growth, but I'm reducing my risk. So speculators, risky, hedgers, reducing risk. Just like with the option that we paid a premium for, with the commodity, we are paying margin. Long, I think it's going up, short, I think it's going down, and this is going to be a lot cheaper than the margin requirement for shorting stock. So I am potentially on the hook for a lot more. So this is going to be riskier. Margin profits, the small margin requirement is why it's so risky. Only a very small percentage of what I actually am going to have to pay to receive these goods. Okay, so our example, farmers thought that their soybeans were going to sell for $5 or less this year. Cal comes in and says, hey, I think it's going to be higher. I'll pay you $1 today and $4 upon harvest. We've got a specified time there of October. So they agree they're going to get $5 total, and $1 of that they get now, time value of money, that's even more valuable. They're able to take that dollar and invest, do whatever. With the contract alone, farmers can go to banks and say, hey, I need to borrow money to plant, to sow, to do whatever with my farm. So he was able to sell it for $10 because the Navy came by, and farmers expected to have $4 or $5 for it. So they got their dollars ahead of time. They should be happy based on their expectations. And Cal is really happy because he doubled his money. He gave $1 initially, $4 at harvest, and then sold it for $10. And then Dr. Seuss giving you some motivation. You learned a lot. So final exam, basically next class we'll have one more topic covered. So final exam, we get back from Thanksgiving break in time to cover maybe something else, and then you will have, if you qualify for the super bonus fund, the ability to just take the average of the first 3 exams and make that your final exam score. Or maybe you did poorly on an earlier exam, take the final and average of your 3 highest or replace your lowest. Want me to go back over some of those earlier chapters?